Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 22 of our YouTube channel and podcast, and I'm very excited to just continue talking to you guys about these personal finance topics that I really hope are helping you out and helping you move forward financially, and hopefully we can continue doing that in this video as we talk about the topic of compound interest. Now, compound interest is something that you need to understand if you're going through your investment process and you're investing money actively. You really need to understand compound interest in order to really understand what's going on with your money. Compound interest was best described by Albert Einstein when he said the following quote. He said, "Compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it." And so that we're going to dig into what he means by that, but that's something to keep in mind as we go through this video. Before we get too far in, if you could go down below and click the subscribe button, like this video, leave me any comments, any feedback that you would like to about this channel or this particular show, and I'll be glad to have a conversation with you and try to give the people what they want. This show's about you. It's not about me. So hopefully I can provide you with the information that you want and you need. If you're listening on the podcast right now, I appreciate you on Apple or Spotify podcasts. If you aren't, you can listen there. And anybody who is or wants to, just go and subscribe. You can subscribe, like I said, on Apple Podcasts or Spotify Podcasts. Also, follow me on social media at MNO with Dylan, and you can check out our website, www.mnowithdylan.com, to find out about the different services that I offer, the financial coaching, things like that. And hopefully all those resources will be really helpful to you, and you can find something of value in those things. So, what is compound interest? Baseline question of the day. What is compound interest? Well, very simply, it is interest earned on interest. Now, what do you mean, Dylan? Interest earned on interest? Well, it's not just interest earned on the initial amount of money. It's interest earned on the initial amount of money plus the money that money has gained. So, for instance, with your debts, right? If you've had debt or if you currently have debt, and let's say your debt balances have grown. Well, if you notice, the way that they grow is not just based on the initial amount of debt. It's okay, if the interest rate was 4%, then you'll see a 4% increase on the initial amount, but then from there on it's 4% on the previous amount. It's not 4% on what you began with, it's 4% on what the balance is now. And so that's what compound interest is. It accelerates the growth of money. If you see a chart that is trying to show you what compound interest does, it's an exponential curve, because as you begin to make the same rate on more and more money, that money is making more money because you're earning interest on interest. And what you'll see on that graph is that in the beginning, the curve is very flat. It's very shallow curve, because when you have less money and let's say you're making 10%, that 10% is not a whole lot percentage wise. Like 10% of $1,000 is far less than 10% of $1 million in real dollar value. So that's why you see the balance grow in an exponential way. And that's so important to the growth of your money. You may think, Dylan, I don't need to hear exponential. But if you want to understand how your money is going to grow when you invest, or how it should grow, it should follow some type of exponential curve. So compound interest differs from simple interest. And you may say, okay, well, then what's simple interest? So let's use this example. If there's $1,000 and $1,000 is compounded at 10%. Well, the first period that it makes 10%, it'll be $1,100, correct? And then the second period that it makes 10%, it'll be $1,210. So it made $100 the first period, and it made $110 the second period because it earned interest on the interest and the original principal. So that's what compound interest will do. But simple interest is simply going to go, okay, if you're making 10% on something, then you're just making 10% off the principal. So every period, you're going to make $100 on that 1,000, not 100, 110, 121. Like it's not going to work that way. And you may say, well, where does simple interest occur? Well, simple interest can occur for individuals who are systematically taking money off of their investments, or with dividends. Dividends is a particular place where simple interest occurs. So if you were to have a stock that was $100 and it made a 3% dividend, well, it would pay you $3. Well, if the price of the stock doesn't move and it continues with a 3% dividend, well, it's going to keep paying you $3, $3. So that would be a simple interest example. And it's not that simple in many, many cases, but it can happen that way with fixed income investments and with things like dividend paying stocks. So just for example, if you had 10 periods of compounding of $1,000 versus 10 periods of simple interest at 10%, then you would have $2,594 if you were doing compound interest, but with simple interest, it would only be $2,000. So you see the disparity already. Well, the disparity becomes even greater if that amount of money increases. That's why I was talking earlier about the exponential curve of compound interest. So you'll see that disparity become wider and wider. The more time, the greater return, and the more money. So how does this work? Let's talk about one quick example of, let's say you purchase a stock or a mutual fund and you have a share that costs $100, right? Well, let's say you were to make 12% per year on that share. Well, after a year, you'll have $112. After 2 years, you'll have $125.44. After 3 years, you'll have $140.49. And then if you jump to, okay, after 10 years, you'll have $310.58. But then after 40 years, you'll have $9,305.10. So that's your money compounding on itself. You see how it jumped, how it went from, okay, in 10 years, I had only made, $210 in interest. But over those next 30, you really saw the rise in the making interest on interest. So then similarly, if you want to look at a simple interest example, let's say you invest in some kind of fixed income investment like a bond or income producing real estate or dividend paying stock, and you're taking the money off of that. You're not reinvesting that money. You're just taking the money off. Okay. And let's say, once again, it's a $100 investment, and you expect to make 12% per year again. Now that can be very high for a fixed income investment, but we're just doing this for example's sake here. So after 1 year, once again, you'll have $112, just like you did with compound. Okay, but 2 years, you only have 124, so that's a little less than with compound. 3 years, 136, that's a little less than what you had with compound interest. After 10 years, you only have $220. Well, that's a good bit less than what you had when we were compounding. But then after 40 years, you only have $580. You would have only made $580 on that particular investment because things weren't being reinvested. You were not compounding. You were just making a simple interest value. Well, you see that the difference in compounding and simple interest of that same value of investment making the same rate of return, the difference is quite large. It's $8,700 approximately difference between those two choices. And so it just shows how compounding can really grow your money and grow it long term in a way that something income producing doesn't necessarily do unless you're reinvesting the income into that thing. Now, something that may hit a little closer to home and make you care a lot more about compound interest is if I give you a debt example. Well, let's look and say you have $25,000 of student loan debt, and a lot of people have $25,000 or far, far more in student loan debt. Well, let's say you've got $25,000 in student loan debt and it makes 5% interest. So you are paying a 5% interest rate. Now, something a lot of people don't know about student loans is many of them compound daily. So they're actually going to compound quicker than something that may compound monthly or annually or something like that. So you're earning interest daily. Daily, the interest payment is becoming larger. The balance is becoming larger. And so you got that 5% daily compounding. And let's say you were to defer it for 5 years. So that's something that a lot of people do as well. They defer their student loans. And so let's say you defer it for 5 years. Well, guess what? Now, instead of $25,000 in student loans, you have $32,100 in student loans. Why? Because of compound interest. Money was compounding. The loan was compounding. Now you owe an extra $7,100. This highlights the importance of paying off debt quickly, because if you fail to do so, your debt's going to compound just as your investments can compound. So like Albert Einstein was talking about, he who understands it earns it, right? So he who understands it earns it. So if you're investing and you understand compound interest, you're earning compound interest, but he who doesn't pays it. So he's saying if you aren't really understanding what's happening to your money, then you're far more likely to be in debt and paying compound interest to somebody else and to some bank or some institution or something. And so you see what he was talking about now when I was talking about that quote, and why we want to be on the earning side and not the paying side. And so you notice what compound interest is going to do on the negative side is it can keep you saddled with debt longer and longer. And this is one of the reasons why I call for you to get out of debt, is because we don't want our debt balances growing. We want our debt balances to decrease. And especially with things like student loans and credit cards that you can pay minimums that aren't going to decrease the balance, then this can really, really hurt. Compound interest can be the detriment of your financial life at that point, because you're just pouring money into a pit, and that pit just continues to grow whether or not you're putting money in it or not. And when you understand this concept of compound interest, then it's really going to pique you into, I want to earn it. I want to be the one on the receiving side of compound interest and not the one on that side that has to pay it, because the individuals that pay it, they're in bondage to compound interest. They're in bondage to debt. But those who are earning the compound interest, they are free. They are receiving from the investments that they have to be able to live financially free and be able to do the things they want to do. But that's not possible when you're saddled with paying compound interest. And you also may see the importance of high interest debt. So let's say like a credit card. And let's say your credit card, just for example's sake, has a 12% interest rate. And that's actually kind of low for many credit cards. Let's say it's got a 12% annual interest rate. Well, monthly, that's 1%. So if they're compounding monthly, every month your interest and your principal grow by 1%. And so you see that slow burn of your money growing, or your debt, not the money that you have, but the money that you owe growing. And that can be really dangerous on high interest debts, because they can grow extremely fast, and especially with credit cards, because like I said earlier, they're going to make you pay minimums that aren't going to dig into the principal amount that you owe. So that's a problem. And that's why we want to hit debt hard and go so fast when it comes to paying off debt. And it should incentivize you to get compound interest on your side, and not on the side of having to pay it and having to be enslaved to it and in bondage to it. Another way that compound interest is particularly negative is with inflation. So the value of goods and services in the economy may increase by certain values annually, by a certain percentage. Now, that percentage is not fixed, and it's not an amount that somebody chooses, but it is heavily regulated, and it's heavily determined at the Federal Reserve. They want to keep a 2% inflation target annually. Well, if they want to keep a 2% inflation target, that means the price of everything and the price of all goods and services are going to increase by, on average, 2% annually. Well, okay, so why is that important, Dylan? Well, what that also is doing is any money that you have in the bank, let's say it's not making anything, it's declining in value by 2% annually. And so what's happening is the value of your money, although the dollar amount is going to remain the same, the purchasing power, the amount of things that you can purchase with that fixed amount of money is declining annually by that 2%. And that is also a compounding effect. That's why things today are far more expensive than they were 20 years ago, 30 years ago, 40 years ago, because inflation has compounded to the point where money is not worth as much as it once was. And this is why it is important long term to make really good returns on your investments, because if you're not earning enough on your investments, your real return, and what do I mean by real return? It's your actual return. So let's say you were to make 9% on something. Well, if inflation is eating into that 2% each year, then your real return is somewhere around 7% annually. That's not perfect. That's not a perfect calculation, but it's somewhere around 7%. So even though you're making 9, the real value of your money is only increasing by 7. So that's why it's so important to make good rates of returns, because if you're making, 3, 4, 5% and inflation's 2, then your real return is minimal. The true value of your money is not increasing that much. And when it comes to compounding your money, there's 3 things that I want you to keep in mind that are particularly important for growing your money, and 3 things that can be really important when your debt amounts are growing are the amount, the number of periods, and the frequency. So let's talk about those things one by one. Obviously, you make more money on more money invested. So 10% of $1,000, like I said earlier, is far less than 10% of $1 million. So the more money that you have invested, the more you're going to benefit from compound interest. And similarly, the more debt that you have, the more that compound interest is going to hurt you and impact you negatively over the long term. And then the number of periods of compounding matters. Now, what do I mean? So yesterday I talked about time being your friend, right? Well, time is your friend because when you have more time, you have more periods to compound your money. You have more time to compound your money. And that's important, because like I talked about earlier with the exponential curve, it starts to get much, much steeper as time goes on. And that's why time can be your friend, and it can also be your enemy, because on the shorter end of that curve, you're not seeing much of that exponential growth. And so if you start later, you're likely to see a very shallow curve. But if you start earlier, you can see the full exponential curve and your money grow at a very steep rate as it increases and compounds upon itself. Then the frequency of compounding matters. Now you may say, what do you mean about frequency of compounding? You just said number of periods. What do you mean by frequency? Well, when your money is compounding, so when your money is growing, it may not be growing every day, and it may not be growing every week. So let me give you a realistic example. Earlier, I talked about student loans and how a lot of people don't know that they compound daily. Well, what does that mean? So if you had a 5% annual interest rate on your student loans and they compounded daily, what they would do is they would say, okay, 5%, and divide that by 365 or however many working days there end up being in a year. And they would say, okay, every day we're going to give them this small portion of interest, and we're going to increase their debt balance by that. And so that's what daily compounding can do to your debt. It can slowly increase it day by day. And the more frequent compounding is occurring, the faster the money is going to grow. Now, similarly to that debt example, to that student loan debt example, every day with your money that may be invested, let's say in a particular stock, well, every day that money's growing as well. Now, it's not a fixed rate of return, so it's hard to say, that it's true daily compounding, but it's increasing or decreasing in value by a certain percentage every day. And so you can, if you're looking at an average, you can say that it is compounding daily. Now, something that may not be compounding daily is something like if you have some kind of fixed income investment that you are just reinvesting into that fund or that particular bond or whatever it might be, then that might only happen once a quarter, or that might happen once a month. And if that's only happening once a month, then your money's only compounding that often. It's not compounding daily. And so that's an important thing to remember. And you really want to make sure that if you are earning compound interest, which I hope you all either are or will get to that point, that you have the most money in there, you have the most periods ahead of you, and the most frequency of compounding, and that will grow your money the fastest. But if you have debt, hopefully you have the lowest amount, you have the least number of periods, and you have the lowest frequency of compounding as well. So compound interest is vital for you to understand moving forward, because if you're not growing your money and your money is not compounding and you're not allowing yourself to see that exponential growth of your money, then you're going to have a hard time getting to where you want to get to financially. And yes, this concept does not have to be on your mind at all times, but it will allow you to know what you're looking for. It will allow you to know what needs to happen in the long term. You need to be earning this interest on interest. You need to be seeing your accounts grow, your investment accounts grow by earning interest on interest. And you need to see your debts declining, hopefully, right? If we're paying them off. But if they're growing, then you're going to see them grow interest on interest. And that's why we need to get rid of them. And that's why we need to make sure that we're taking the steps that we need to take to not be the individuals that are paying compound interest, but the individuals that are earning it long term. Because quite simply, compound interest is only really going to work long term. That's why you always hear me say when I'm talking about investments, I always say such and such long term or over the long term. Why? Because the only way compound interest is really going to work for you in most investments is over the long term. And so I want you to be compounding as long as possible and always continue to allow your money to grow and compound upon itself. That way you can build a good nest egg for yourself. That way you can live the life that you want to live financially. And this is only going to happen if you do the work, you find the investments that are good for you, you understand the things that you're putting money in, and you put money in the accounts like we've talked about previously. That's no surprise to you. But if you can start early and you do start early putting money in investments, this compounding effect is just going to be crazy, and you're going to look up later in life and not even understand how you got to the amount you did. It can only be described as they compounded. The money compounded. The investment principle of compound interest is the most important to understand in your wealth building journey. So you have to have that knowledge first and foremost. Before you can really truly believe in your wealth building and in your ability to build wealth, you have to know how you're going to get there. And the answer is compound interest and compounding your money. And so that's why this is so vital to understand. Yes, it has a dark side, but let's make sure that we keep using compound interest as the true eighth wonder of the world it is, and not as something that can tear us down and tear down the value of our money over the long term. Let's allow it to be something magnificent, and that's going to help us, and that's going to be a beacon that we can allow to shine light on our financial life over the long term, and always be compounding, always continue allowing your money to grow on top of itself. And don't pull money off early on, especially if you don't have to. Allow that money to roll over, and it's just the effect is going to be amazing. That exponential growth is going to blow your mind. So hey, I appreciate you watching this episode. This is a lot of fun to talk about. I like going through these investment principles with you guys. I've got a couple more of them for you in the next few days, and I'm really excited to talk about those with you. Once again, subscribe to the channel, click the like button, leave me some comments, follow me on social media at MNO with Dylan. Check out the financial coaching services. If you want to talk more about compounding your money, you want to talk more about a plan that will get you to the place where you can allow your money to grow for you, then we can do that. So check it out, www.mnowithdylan.com/workwithdylan if you want to check out the financial coaching services that I offer. So tune in tomorrow as I talk about the idea of diversification. That's another investment principle. And how that impacts your investment portfolio. That'll really be an interesting topic to talk about. I'll also look out on Saturday as we have another weekly rewind. Those come out every Saturday. And if you miss anything or you want to be able to look back at the things that we covered, you can do so on those videos. Also, if you're on the podcast, thanks for listening. I really appreciate it. Make sure you subscribe to the podcast. If you want to go listen to the podcast on Apple or Spotify, you can do so and subscribe to that there. So, hey, thank you guys for tuning in to this episode of Money's No Object. I am your host, Dylan Howell. God bless.